Good morning, students. Today we want to look at analytical procedures. Now, these are from your PowerPoint slides, so if you go into Test 3 material, this is what you'll find. Let's kind of browse through these PowerPoints. Okay. First of all, analytical procedures comes under a category called substantive procedures, and those are procedures that are designed to detect material misstatements in the financial statements. We've already calculated materiality. If you remember, we did that a while back in one of the other in-class exercises, so you can go back and review that. But we want to look at two types of substantive procedures, analytical and test of detail. Now, I'm going to send you this handout that I've written down because I want you to be able to follow this, and I wrote it down on a sheet of paper, so I'll send this to you. It gives you a little better perspective. Substantive, the definition's meaningful, independent existence, and the reason we do it or have these or to detect these material misstatements or fraud. Two categories, just like we had on the PowerPoints, and let's kind of go to the test of details first, and then we'll get into the analytical procedures because it's more extensive. Test of details would be testing account balances, tracing back your journal entries, footing your columns, going back and checking to see if they added them correctly, doing a bank reconciliation, which we're not getting to yet. Look at certain classes of transactions, accounts receivable, okay, inventory. And when we get into audit planning, you're going to each have a different category to test or to look at, and you'll know a little bit more about how to do that. Then you test your disclosures. That's the information in the back of your financial statements. For instance, if they give you a list of debt, okay, they tell you where their debt is. You want to send out confirmations to make sure that debt is there. That's how you're going to test it. Now, under analytical procedures, we have two types, financial and non-financial. Okay, non-financial would be things like observation, walking around, looking at how they do the mailroom, sending out confirmations of accounts receivable. But our focus is going to be on the financial aspect, and there's three categories here of financial. First of all, there's what we call trend analysis. Okay, and that is going to be comparing from one year to the next. Okay, comparing from one year to the next. Now, there is another handout I'm going to send you. Let me see if I can find it here. Maybe we should go back to the PowerPoints first. Okay, when we're looking at these analytical procedures, the next thing they have here in the PowerPoints, when do you do that? When do you do all of this? Do the numbers. Well, you're going to do it at the beginning, you're going to do it at the end, and you're going to do it within your audit. So just about all the time you'll be referring to numbers. Okay, so you'll have to ask yourself if the amounts appear reasonable. If they don't, you go back and check them. Okay, now I wanted to point out, we had just looked at the term trend analysis. Let's see if this is going to move forward. Analytical procedures. Okay. More steps. Decide what numbers you expect, what balances, determine the differences, compare it to your expectations. Does it meet what you thought it should be? And get into that a little bit more. That's more into your assignment for number 12. And then if it's not within the range of materiality or what you expect it to be, like accounts receivable, then you want to do some more testing, investigating. Okay, now I mentioned trend analysis. So these are all the forms of analytical procedures, and I've also put them down on this sheet. So I mentioned trend analysis. You want to look at one period to the next. Now, there is a handout I'm going to send you, but it's also in the textbook. It's figure 5.4. And this is not Keystone, but this gives you an idea of all these different types of analytical procedures. Let's zero in on trend analysis. Now, they have 2 years up here. They have 2016 and 17. Trend analysis is going to be taking the difference between these two numbers and then dividing it by the previous year. And we get what's called the percentage change. Okay, so that's analysis from one year to the next. Now, you could just look at the flat out numbers, but they oftentimes don't give you the true picture. Okay, 78 in this case. It has thousands, but you should add zeros behind it, so it would actually be millions versus 82 million. Okay, the trend is that there's a change from one year to the next of 4.8%. Okay, looking at other numbers, let's kind of zero in on some that look a little bit out. Okay, look at that returns and allowances. It almost doubled, it looks like. Okay, just the flat out number. 2,284,000. Remember, this is an estimate. This year it's 4,235,000. Those are the amounts that you don't think that your accounts receivable will pay. And remember, in Keystone, they actually started extending to high-risk customers. Now, it looks like it doubled just looking at it, but look at what it actually did. There was an 85% change. That's huge. So when you're making an analysis and you're doing trend analysis from one year to the next, you want to look for these big, outrageous changes here. This would be one. Okay, coming on down here, when you have negatives here, we had a negative income from operations here, negative income. That's not good because you want the income to go up. So if it's a negative number there where it should be a positive, there should be some concern there. Coming on down, let's look at, what is this, income taxes. Looks like it doubled. Well, in all actuality, it went up 62%. That's a concern. Why do we have such large taxes? Investigate that, okay? Again, net income actually went down from one year to the next. You can see, okay? But the percentage change was almost a negative 70%. That's troubling. You need to investigate that and see what happened. What numbers here? Was it that the sales didn't increase enough? They did increase, but you've got a big increase in some of these expenses. Selling and administrative expenses, maybe not huge, but it did increase. So many of your expenses increased, and the primary thing was it looks like your income taxes increased, okay, a good bit. So investigate that. Look, there was a 62% change there in your taxes where I have the number, the sign. Okay, so that's what we're calling trend analysis. Now, another type of analytical procedure would be your budgets, and I don't have that listed on my sheet, but you do have budgets and you want to see how well did they meet those budgets. And we've talked about budgets before in 202 and cost. Remember, material variances, labor variances. Try to figure out what happened. Okay, now we want to get into this vertical analysis and then ratio analysis. So let me go back to my little sheet that I did here. A little more complex than your trend analysis will be the ratio analysis, where you put one number as a numerator and one as a denominator, and that's what you're going to be doing in number 12 of your assignment. Now, ratio analysis involves a review of ratios once you get them over time, how have they increased or decreased. It involves what's called cross-sectional analysis, where you want to compare that to either a similar firm or an industry number. Industry is going to be what, like the technology industry here. So there would be an average that would be what we call a benchmark, that you could see how far off they are. Or you want to look at vertical analysis, which is going to be going down the financials. You would be dividing all the income statement items by sales to change them to percentages, or you would be dividing your balance sheet items by total assets. So remember that for test purposes. You may have that. So let's go back to the sheet 5.4. Let's take a look at that again and these different numbers. Now down at the bottom, if you've noticed, they've already done some ratios. We'll go through these: current, quick, receivable, turnover. I'll give you the formulas for those. Okay, you can look at those and you can tell that, like the current ratio, which measures how much liquid cash you have compared to liquid liability, current liability, should be around 2. So they're getting that up. That's good. Quick ratio should be around 1, so that one's good. Receivable turnover, how many times are they collecting their accounts receivable? In this case, it went up slightly. So 5.6 times in the year. Now, that's not every month, though, and it should be around every 30 days. Days sales and ending receivables, okay? This is a measure of collection of accounts receivable also. Inventory turnover, how often are you selling your inventory? It actually decreased here. Days sales and ending inventory, okay, that decreased. Again, it's a measure of how many days here do you go before you sell your inventory. So these are in terms of days. This is in terms of times. And interest expense, how much interest are you paying according to the debt that you have. Now, you can compare these across time here. You could compare them to another company. Or over here on the far side, there's what we call a benchmark. These are numbers that you can compare them to see how it lines up. For instance, the current ratio, they have a 1.9. The industry as a whole is 2.1, and this is Brody Corporation. I'm not sure what it is. Okay, so these are numbers that are based on all the businesses within that particular industry that they operate, and that's a good comparison there. Okay. Now, the other thing that we didn't look at is vertical analysis. So that's when you're going down the financials, and in this case, okay, here, we're going to see the 105 and 107. What that means is they took their sales number, gross sales, and they divided that number over here, 82, into all the numbers on your income statement. On this one, they divided gross sales into all the numbers on their income statement there for that year. So what we have here, and I'm thinking, you know what, let me back up. I said gross sales. In this case, I think it was net sales, because this one, whatever number is going to be 100 is what they're dividing by. So it's going to be net sales that they divided by. Okay, so they converted all of these to percentages. Notice that that's going down. That's called vertical analysis. And then they can compare again across time, okay, which would be more like a trend analysis here, okay, or they could compare to the benchmark here, industry. So those are what this is talking about, and I'll send you these and you can take a look at it. Do remember, there's one question I like to ask. On the income statement, you divide by sales, and on the balance sheet, you divide by total assets to get that vertical analysis. So where do they get these benchmarks? Well, they get those benchmarks from places like Dun & Bradstreet. Okay, and you also have that relationship between your financial numbers and your non-financial. Here's an example. If you're looking at sales, compare the number of sales orders to revenue that you have, and even floor space. Are you able to produce and sell what the number projects that it is? Okay, so I'm going to move on to the next slide, and they've given you some information about trend analysis here. How you got it, what I said was you take the difference between the 2 years and you divide by the previous year, which is what they did here. Okay, horizontal ratio analysis. Now we have some different categories, and I'm going to give you even more categories. I'm going to send you another sheet that tells you what all these mean, and I like to do this, have these on the test, so you need to know that. Liquidity ratio is how are they able to satisfy their short-term debts or their debt in general. Activity, how are they doing as far as collecting accounts receivable or selling inventory. Those are going to be your turnovers. Debt, measuring how much debt they have compared to maybe stock. Profitability, how much income is compared to other numbers on the statement. And this market ratio is a measure, we're not going to do any of those, but it's a measure of how well others in the market want your firm. So you need to know, I'm going to send this to you also, but you need to know these. Now let's see what's on the PowerPoints. They give you some basic liquidity ratios, current, quick. Those are a few that you'll end up having to do. And then leverage, that's also called debt. If you're leveraged, that means you have a lot of debt, and that can help you in at certain times. When the economy goes bad like it is now, though, you don't want to have a lot of debt, or those bankers are going to be calling on you. So Donald Trump actually leveraged his firm and did very well until I guess it was 2008, or maybe it was back in the 90s when he got in trouble with his gambling casinos and he had to file for bankruptcy. So it can go against you. And these are two measures of leverage, which also means debt. Profitability, these are a couple measures of profitability. Gross profit percentage, that's the same thing as taking your gross profit or gross margin and dividing it by sales. And then return on total assets. And then you have your activity, which would be your turnover ratios. How quickly are you selling your inventory? That's what it measures. You don't put it in percentages, you call it times. And then your accounts receivable turnover. How quickly are you collecting your accounts receivable? Next I have Z-Best. Now we had skipped this, but I do want you to take a look at it. I wrote down the answers, and they wanted you to do some calculations. Quick ratio, accounts receivable turnover. Okay, so let me kind of go back and forth. Let me skip back to the previous slide here. Okay, here are your numbers. And when you're doing the quick ratio is going to be cash plus accounts receivable. You don't want to include inventory in there because it's too difficult to sell. So cash plus accounts receivable divided by current liabilities. So I pulled numbers off of this statement. Your cash for the first year would be $30,321, accounts receivable 0, and then your current liabilities 2,930. So on that one we got 10.35 to 1. That's really high, and it's because they didn't have any accounts receivable at the time. The next year though, Z-Best did start using accounts receivable, accepting credit, and so the numbers went, if you look, 693,773 plus 87014, and you want to divide that by your current liabilities of 1,768,435. So it dropped significantly to 0.44. That's too low. So he went from being really high to really low. You want this number to be around 1 to 1. In other words, you can pay off your current liabilities. Now the next one was the turnover. Accounts receivable turnover was sales divided by average accounts receivable. So in the first year, you can't calculate that. They had no accounts receivable, so it's not even able to be calculated. Second year, you would take that accounts receivable, that's going to be your denominator, and you'd add it to the previous year and divide by 2. And then you want to divide that into your sales of $4,845,000. Okay, the number ends up being, where is it? 13.96 times. Okay, so they're collecting their accounts receivable about once a month, and that's good. Okay, once a month's fine, every 30 days. Gross profit percentage, this is similar to getting your vertical analysis, but what you want here is to get your gross profit, sales minus cost of goods sold, and you want to divide by sales. So in the first year, you see your sales, cost of goods sold up at the top, do the subtraction on each of those, and then divide by your sales number. So what you have is 0.54 or 54% for the 85 year. You have 58% for the 86 year. Okay, now the difference here, this is telling you how much gross profit you have left to cover your fixed expenses. The difference between 100, now what number is going to be 100? It's going to be sales. So the difference between 100 and 54 is how much you have invested in cost of goods sold. So for this one, it would be 46%. Over here is 42%. You want the gross profit to be higher and the cost of goods sold to be lower. Okay. And let's see. Let's get back to inventory turnover. So let me go down. One more thing, vertical analysis here is going down where you're dividing every number, in this case by net sales. Net sales means you subtract out your returns and allowances, what people have sent back to you. So that's the number. Normally, probably on the test, it'll just say sales, so that would be your 100% number. Now, they wanted you to do that for Z-Best, and I just calculated it off the previous slide. So what you have here is sales minus cost of goods sold equals accounts receivable, gross profit. That's what that 663,830 is. If you divide those three numbers by the sales number, you get 100%, 46%, 54%. And we talked about that in the previous gross profit percentage. The other one ends up being 58%. So this is called vertical analysis, where you're converting all the numbers to a percentage so you can compare. And the thing you want to notice here is that your gross profit percentage went up. That's good. The cost of goods sold percentage went down. That's good. Okay, you do want to minimize your cost of goods sold. Okay, and it talks about comparing. What do you compare it to? You can do trend analysis to a previous year. You can do it to another company that you're looking at. And you can do it to the industry average, which is a benchmark. Effectiveness, to get the best numbers. Now it's more cost effective. Used to, it was more expensive doing it all manually. The main thing I want you to see is precision. The more samples you have, the better the precision, okay? So the more often you do this, the better, the stronger the numbers, the more precision that you have. And it depends on how predictable it is, technique, and reliability of data. As far as that, I want to point out one other thing to you on this sheet. Okay, the third thing that we don't do is regression analysis in here. You do that in statistics. That's the most complex form of analytical procedures. That's what you use in statistics, and it shows you what we call pro forma or as if financial statements. Those are budgeted financial statements. Okay, so that's the one we're not going to do. Okay, I think that takes care of the overview of the PowerPoints. We've gone 22 minutes. I'm going to do a different video for the homework assignment. So study these PowerPoints and know what we're talking about in all of this. Okay.